How's it going, everyone? Christian Szpilfogel from Aliferous. You were just on stage at the Multifamily Conference, and most of the panel was very pro-USA for reasons such as the U.S. is, 90% cheaper than Canada in terms of real estate, broadly speaking. There's a lot more states there that are landlord-friendly, so everyone's very hopped up in the U.S. You were put on the spot for being more about Canada, even though there's a little bit more restrictions here. I mean, we're not as big of an economy. Anyways, why don't you talk a bit about what your thesis is for investing, and then we'll get right into why Canada over the U.S., because you're very much standing strong on Canada. I would love to hear that.
Sure, absolutely. So I wouldn't say that I was put on the spot. Seth knows very well that I'm actually pro Canada, and so it's
you're ready for it.
He knew what my answer would be. Or expected what it would be.
For sure.
And I just look at things on a more fundamental basis. So to me, it's not Canada versus the U.S. It's where are the economic fundamentals? Where does the business case make sense?
Yeah.
And I find that in scenarios or in geographies where you have a lot of challenges in order to be able to build new rental units, for example, that means that vacancy rates are going to stay low, and that means your rental rates are going to stay relatively high. So as a builder, I'm not excited about doing new development within Canada in most areas.
Right.
And in that case, if I was building, I would look at friendly U.S. states for doing that. The yield is better. You're going to get a better return. But in terms of acquisition and repositioning, if there's not a lot of new product coming onto the market, your product that you have, that's incumbent product, fundamentally becomes more value.
Right. Yeah.
So that's really why I'm bullish on it. So Ontario's incredibly stable. It's got a fundamentally strong economy. It's very diverse. So a lot of people have gone to New Brunswick or Alberta and
cheaper real estate, etc. Yeah.
Cheaper real estate, but that kind of bugs me when people say cheaper real estate.
At what cost?
Yeah,
exactly. So what are the things that...
Yeah, and I'm not saying you're saying that, but that's what everyone says,
of course, no, it's sales from the roof. No, people have said that a lot. So
right, but it's cheaper, but you also have to take a look at what your business case is going to be. So if the business case is relying on appreciation or cash flow, etc., right, then it has to be in proportion. So you don't want to pay Ontario rates in New Brunswick, okay? But a lot of Ontario investors went to New Brunswick saying that, oh, this looks cheap. Well, it does relative to Ontario, but there's other things to consider in terms of economic growth, population growth, etc.
Yeah.
And then you look at Alberta, wonderful province. It's got certain cities are really very diverse, but it's fundamentally a petroleum economy. So if the price of oil shifts up and down, it makes a dramatic difference in terms of the performance of the economy in the province. You look at Ontario, it's a highly diverse economy. And then one of the reasons that I like about Ottawa in particular is that you get not just the diversity of the private sector, you also have the federal government in there.
It's very steamed.
So exactly. And what happens when when we have a recession, private sector is suffering and you get some economic issues, the public sector grows, right? The federal government goes into a surplus, right? So you've always got this offsetting effect.
Well, and they went up 40% in staff costs, and they
absolutely did.
Some people weren't happy about it, but hey,
in the good times,
right?
And that was in the good times.
Right.
It's about 2017, right? So the private sector was on fire,
right?
And you have the public sector now growing as well, which is why Eastern Ontario just benefited so much,
right?
But at its heart, it's a very balanced and stable market, and you can make very predictable business cases based on stability. So if your business case relies on what's the market going to do? To me, that's a shaky foundation.
Yeah, it's very much based off a prediction or a hope, or there's more risk, right? So
it's not something you have control over.
Yeah,
and I like control.
Yeah, reasonable. So then, for the recent mortgage holder wants to now look at multifamily, or just go to a greener pasture, so to say. You're saying that unless they're well capitalized, have a strong stomach, and are willing to jump through a few more, let's call it political or red tape hoops, Canada is like why jump south of the border when you've got Canada in a very stable format where, and I guess who is the ideal investor for a more stable case, right? Is it better for a first time investor, or Like, what's your thesis on like someone who's just sort of starting, and it can be a small building. Let's say they've got $1 million property, right? Like, I don't know, in Edmonton, a small multifamily there. In the States, there's an equivalent to an Edmonton sort of place. Like, let's go off like $1 million that they're going in total. They're putting down 20%. Maybe them and a partner. U.S. versus Canada in terms of something small like that. Let's bring that to life.
Yeah. So one of the things about the U.S. is if you're in a developer-friendly state,
meaning that there's incentives.
There's incentives. There's less paperwork and impedance. They're trying to do whatever they can in order to create more units.
Are these generally red or blue states, or just
They're generally red states.
Good.
Yeah, they're overwhelmingly so.
Yeah.
So, and that's not a political statement. It's just a reality.
Yeah.
So they tend to be more developer-friendly. And the interesting thing that happens with that type of environment is when more supply is required, more supply is built.
Mm-hmm.
Now, there's a problem with that. Now you're basically build to suit. And so what ends up happening is the price and the appreciation side of it is kind of limited on that side of it, because it'll float based on inflation.
Yeah.
But you can't push the value of properties, unnaturally high, because they've always got sufficient supply.
Right.
Okay, so that means that if you invest there, it's got to be about the cash flow, and your business case has to be fundamentally surrounded by the cash flow.
Right.
And that's fantastic, because to me, cash flow is the very first step.
Sure.
Anyway.
Right.
The nice thing about investing in Canada is that because of the supply of limited supply, we can do the cash flow thing. And I want to really emphasize this. You can buy assets where you either cash flow an acquisition, or after execution of a business case, you get it to cash flow. Okay?
Right.
It's possible. This is what I do every single time. And if you have cash flow off of an asset, you can scale your business, because that cash flow goes towards paying for people to do things. Right? If you're cash flow negative, you're subsidizing it. You can't scale.
Well, for sure.
You eventually reach a point where I can only absorb so many properties.
Mm-hmm.
So that's why I was saying, on stage, right, you have to have cash flow first, figure out how you're getting cash flow out of that project.
Mm-hmm.
And then after that, you figure out where you're going to get new equity.
Right.
So
that's the forced appreciation, or
absolutely, yeah, and it's mostly forced appreciation in that case, because natural appreciation is really just inflation.
Yep.
And it's just really reducing the cost of your debt.
So then back to this, small city in Canada, small city in the U.S. You've got the cash flow figured out. It sounds like both ends. You should have one end is more dependent on good cash flow, because there's going to be a lot of forced appreciation in like a red state that has a lot of extra supply. But then in terms of like, let's say we break even on that, both of good cash flow, are you saying it's easier for the appreciation to happen in Canada because of the limited supply?
Correct.
Because more people are scared to go into a place that's not very landlord friendly.
That's right. It's about adding cash flow to your business and adding new equity. So in a market where it's limited supply, it's easier to drive new equity growth. Part of it could be repositioning. It could be value add within an existing building. That can do a forced appreciation. Mm-hmm. But in a limited supply market, it just makes it a little bit easier to do that. Sure. And we also have to think about, when we're talking about business metrics and evaluation, is that an equity takeout is part of your cash flow analysis in a business case metric. So if you're looking at an internal rate of return, right, all of it, if you're down in one of the U.S. states that is really developer friendly, right, you have to make all of that IRR on the actual cash flow, and you get very little out of it from appreciation.
It's not appreciating.
Right. In Ontario, you're going to get the cash flow coming out of it. And then when you do a refinance later on, right, that contributes from a business metrics. That's part of the cash flow calculation.
Got it.
Right.
Which seems to be easier in Canada because of the lack of supply and everything else.
That's right.
That's the key thing.
Yep. So the performance can be really solid. So for me, it's not unusual for my business cases to be well in excess of 30% IRR over a 5-year interval.
Yep.
So, and often it's like 40, 45%, something like that, right? And I've had some as high as 60%. But it is possible to do that in that case, whereas I find a lot of people that are going down the States, they're going to have to be satisfied with the 20, 25% IRR. The cash flow is, the year-to-year cash flow is really strong, but if you look at the 5-year interval of business case, an equity takeout piece of it, right, I'm routinely getting very high rates of return here.
So if you do go down to the U.S., you really got to make sure there's some good tectonic forces that are that are giving it a smooth ride to appreciation. And there's a double-edged sword from it being landlord friendly, because that means there's saturation, a lot more supply. So they really got to do that's kind of the bet there. If you miss that, I mean, you're cash flowing, but you're not having your IRR, right?
But you're right. So if I then kind of back that up a little bit and say, okay, well, let's assume there isn't going to be much equity appreciation. When you do that, that means your business case has to be fundamentally supported by the cash flow.
Totally.
So don't get suckered into paying more for a property, which reduces your overall cash on cash return. And that's what happens is people aren't necessarily thinking about the appreciation side of it or what can happen there. And therefore
they're assuming appreciation.
Yeah.
They're jumping at a deal, and they've already lost from day one.
Their return is just not what they thought it was going to be. So if I'm in a low appreciation market, I'm going to focus more heavily on the cash flow side of it.
Right, unless there's something really unique you can do to appreciate it, but they're probably fighting a pretty big uphill battle.
No, I mean, there's repositioning projects where that can happen, and that's, for example, that's what CPI Capital does, for example, right? And I know you spoke to them a little while ago. So that's kind of what they do. And I do the same thing in Ontario, which is I'll buy an asset that's underperforming. It's got a lot of deferred maintenance in it, and then I'm going to get an appropriate discount to deal with all that deferred maintenance plus extra, right? Because I have to do the work to fix it. And then we just return the property back to a Class A state. And now it's commanding better rents, better revenue, its expenses are reduced, the NOI expands, the value of the property is fundamentally better. That's it. That's the formula.
Yeah, I love it.
Not more complicated than that.
No, people do seem to overcomplicate. This is great. Very good fundamental points, Christian. Appreciate your time, man. Really appreciate it.
You're welcome.
So the next one.
Fantastic.
Thanks again.
Thank you.
That's awesome. Okay, great. That's it, man.
That was good.